I hope you're having a good weekend. I decided to connect with you all to discuss briefly on the subject of personal finance and to hopefully outline a framework that one can use in order to build a model investment portfolio. Without much delay, let's just jump right into it. I'll take you to the slide that I have prepared for this particular presentation. Yeah, so the question that we aim to answer is that what is a model investment portfolio and what is the correct approach of building one? Now, when we are discussing a model investment portfolio, we must understand that there are a lot of variables which determine the health of an individual's personal finance. However, if we have the luxury of making certain assumptions, then we can theoretically outline a framework that an individual within those assumptions can take. And if this is what I intend on outlining, and if it makes sense to you, then you could consider building a portfolio along those lines. So for today's presentation, I'm making an assumption that the individual's incomes are greater than expense. So the fact that someone asked the question that they would like to build an investment portfolio, this is an inherent assumption that the individual's income is larger than his expense, and therefore there are savings which can be potentially invested. To simplify the answer, I have assumed that the individual has no liabilities, and additionally, the individual has no assets at the moment. And to make sure that the base case is covered, the individual has an ongoing health insurance. To get an ongoing health insurance is fairly easy. So, if you don't have one, then at the end of this video, you can simply select a good service provider to cover you for your health. It's not a waste of money. Anyways, so for such an individual who has perhaps an income source, let's call it salary, and this salary is meeting his expenses and resulting in savings, and the individual has no direct liabilities, which implies that the individual does not have any ongoing home loans or student loan, etc. And not just loans, the individual does not also have liability of a person, for example, a handicapped child, elderly, maybe a spouse, etc., children, where the individual is required to pay for them. So there are no major liabilities for such a person. So for such a person, basically, the first approach is to uh, evaluate and to continuously explore additional income sources. These additional income sources are broadly outlined in a pretty famous book, Rich Dad Poor Dad by Robert Kiyosaki, in which he categorizes them into four types, which is understood or easy to remember by the acronym SEBI, which stands for the self-employed, the employed, the businessman, and the investor. A self employed is an individual who leverages his or her technical skill in order to get compensated. And employee leverages the same within the framework of a business to get compensated. A businessman develops a framework and a set of processes which can be leveraged for compensation. And an investor, in turns, invest into one of these or all of these activities in order to achieve, through various financial instruments, to achieve his or her investment objective. So today we would like to discuss that how can we fall into the I category. So which means that currently it is possible that you are a self-employed or an employed individual or perhaps an entrepreneur. But now so which is good, which is essential and has its role in society. But now the question is, how do we become an investor and add this as in our total sources of income? So yeah, so the first step towards creating a long term investment portfolio is to get into debt with absolutely no risk of default and with interest rates as high as possible. Now, in each country, there can be its own scheme, but in India, the best recommended product is the Public Provident Fund or the PPF. So, it does not matter who you are as an individual, it is almost mandatory to have PPF as your first investment in the securities market. The reason is obviously right here that there is absolutely no risk of default and the interest rate is the highest that you can get. The only exception to the PPF is the Sukanya Samriddhi scheme, that is assuming that you have a girl child. So for the most individuals who are perhaps in the age of 21 to 31, perhaps don't have children. So maybe this is not a scheme that they can use just yet. But a PPF definitely is something that can be and should be mandatorily considered. The PPF requires, and alongside Sukanya Samriddhi, require a maximum of 150,000 rupees per year, which amounts to roughly 12 and a half thousand rupees per month. So this investment into the PPF takes care of your first surplus 150,000 rupees. The next step is to once again get into a debt instrument with zero risk of default, with a slightly lower or a significantly lower interest rate, but has the potential of capital gain. All right. So the instrument that we recommend for this is the sovereign gold bond. Now, the reason is that we are in a unique market circumstance where the interest rates are lower, but the interest rates of the PPF are significantly higher, and these are continuously higher at a time when the currency is constant in price. So, also, we are in the market type where gold has given a multi year breakout, and therefore to have 0 rupees invested into gold is is not the best plan when we are considering a long term portfolio. So you need to have some money going into gold, and it is very difficult to time a commodity like gold. And therefore, much like a systematic investment into your PPF, you should also consider including sovereign gold bonds into your portfolio basket. These instrument, by name sovereign, would imply that there is absolutely no risk of default. They give you a 2.5% interest rate, have a 8-year lock-in period, and the price of the bond is linked to the price of gold. So so let's assume the price of gold today is 5,000 rupees per gram. If 8 years later the price is 10,000 rupees a gram, you, the owner of that bond of 1 gram, will get compensated by rupees 10,000. And additionally, during the 8-year period, you will receive 2.5% interest, which is a 20% interest over the 8-year period, making your effective purchase of gold over the 8-year period in absolute terms as rupees 4,000 per gram, and giving you a potential of significant capital gain. Since gold has given a breakout on the upside, we do not want to assume any value on the higher end, so I will remove this. But by considering the interest that we are getting and assuming the current price of gold at this value, for the case of simplicity, it is safe to assume that if gold trades above the level of 4,000 rupees a gram, for the next 8-year period, it becomes a great asset class to hold. And the downside on gold is it is difficult to see a value below 2,500 rupees a gram, but anything is possible. I think the risk is there, but it also has a significant potential on the upside given the strength of the security at the moment. So now that we are investing rupees 1,50,000 into the PPF, which becomes our reference, we can decide to invest up to a maximum. Since we are getting a significantly lower interest rate and the instrument has higher risk, at the start we want to invest lesser than the PPF of 150,000. So the value we can figure out in a bit. Finally, the third instrument that I'm mentioning is having equities. Now, equities have a very high probability of realizing a high risk and a high return. And so, once your money is gone into the equity market, you could be reasonably confident that the one thing that is not going to happen is that the money remains unchanged over a very long term period. So now the only question is whether that change is on the upside or on the downside, and if it is on the upside, does it beat the market or not? And here we have two alternatives, broadly speaking. One of them is you investing directly into the equity market yourself, and the other is going via the mutual fund route. There are several others, such as a portfolio management service or an alternate investment fund, but I will not discuss that at the moment, just like how I'm not discussing real estate at the moment, because we are assuming that the investor has savings but not enough to invest into an AIF or a REIT or any of those investment products. So, coming back to the question that should we invest via the direct equity or the mutual fund, my personal preference has always been to invest via direct equity, simply because it is cheaper, far more efficient, and much easier. And also, when we talk about a 30-year portfolio building, a little bit of research will automatically lead you into some of the best companies currently trading in the Indian market. It doesn't take much effort to zero in on the HDFC, ICICI. Your FMCG basket has HUL, Asian Paints, Reliance. You have Dr. Reddy. Perhaps Sun might show a recovery. We have PSU disinvestments. They tend to give a high dividend. So there is a wide basket to choose from when we talk about direct equity. And if the individual spends certain time on research and to develop a framework of decision making in the market, this process can be very rewarding. However, if the individual does not have the time or the willingness to go through this process, they can consider proprietary trading firms much like ourselves to do it for them, or they can get into the mutual fund space. Now, I'm even though I'm not a big fan of mutual funds, if there is a mutual fund that I would recommend, it has to be Axis Bank funds. The reason being that Axis Bank funds have the lowest expense ratio in the industry for the segment that they're in. They are showing a phenomenally better performance than the fund managers of most asset classes. And in general, Axis Bank mutual funds forms an essential component of most national pension schemes. They seem to be well regulated, low cost, reasonably efficient, and well managed asset management company. So if it is a personal bias or a personal preference that uh, if you were to go to the mutual fund route, consider the possibility of evaluating the mutual funds under the Axis Bank AMC. And if you're going in the direct equity route, you could spend some time you're learning yourself, or you could consult individual experts to help you in that particular process. So yeah, so this would be the approach. And now we have the recommended allocation. Now we need to understand that we are going to use PPF as a reference. That means we are assuming that the first 150,000 rupees is necessarily going into PPF, which means that if our gains and all so 150,000 becomes our base valuation, which means that all the subsequent exposures is going to be in multiples of 150,000. So what happens if, say for example, like we are aware that earlier this value of 150,000 was 100,000. So what happens if the government revises this value back to 100,000 or raises it to 200,000? Then in that case our ratios will change in accordance to that. Remember that we are choosing PPF because it is the highest interest rate instrument, debt instrument in the country, with zero risk of default. And you must understand that even in the event of bankruptcy, divorce, any kind of personal liability, the money that is recovered from PPF cannot be taken away from you. So it is absolutely 100% secure. And in the event that your currency remains constant in strength for the overall period of maturity, it's a monster of a saving asset class. A PPF at its peak strength in a very ranging or a negative market can single handedly thrash these mutual funds, and quite to some extent even direct equity. So do not underestimate this process of building a PPF, and use the value that the government has set as PPF to form a benchmark of what you need to do ahead. So coming to the case, that is assuming you have savings of more than 150,000 rupees. So up to 150,000, it's a no-brainer you're going into PPF or Sukanya Samriddhi. But assuming it exceeds 150,000 rupees, and we are now reach our first, say, multiple of 450,000 rupees, then in that case, the optimal would be to first put your capital into PPF, next put your capital into gold bond, and finally put your capital into equity, such that if your capital going into direct equities is less than 50,000, you it is highly recommended that you go by the mutual fund route. So let's take an example. So say your savings is rupees 250,000, just for an example. Now within this saving, what are we getting? We are getting rupees 150,000 uh, getting into the PPF. And now the question is, what do we do with the remaining 100,000? Now, I would recommend in this case, just as a simple, because gold also has appreciation and is reasonably safe. I would say rupees 50,000 goes each into the gold bond. And since this 50,000 rupees a year is just approximately 4 to 5,000 rupees a month, which does not give you much play in the direct equity market, you could just get into the mutual fund space here. And that about sums up your allocation of how to put in 250,000. What happens if this is to become pardon, I'm getting a call. Just yeah, what happens if this is to become 450,000? We can simply make this 150,000 rupees each, and that has essentially put you in the debt market, the gold market, and the equity market. And once you're going above 50,000, you have a choice now between a mutual fund and getting into direct equity. That's a choice that you can evaluate. So this is a case that we have discussed here, that is assuming your capital is less than 450,000 rupees per month, per year. Saving is less than 450,000 rupees a year. The next case that we have here is that your saving ranges between 450,000 to 900,000 per year. Now, in such a case where your savings are higher, we automatically know that the first 150,000 has gone right into PPF, and leaving behind, let's consider a case of 900,000, leaving behind 750,000 rupees to decide. In such a case, I would put not more than 150,000 into the equity, going 1 is to 1 into the debt market, and allocating 3 lakh rupees of the year into these two instruments, leaving back 600,000 to get into gold. All right. Now the question is, why get into gold? Because you have already secured a substantial base with the PPF. If at all the equities market have to trend, then we do have some money placed in equities. Gold does have a downside risk, but like we discussed, 20% of that downside risk is already compensated for, which means that you essentially get back 120 of this particular value, leaving you only 480 at risk. And gold, unlike crude, is unlikely to get into the negative. So therefore, this in my view forms a good framework for investing this capital. Subsequently, once we cross the, I made a mistake here on the value. We have crossed the 1 million per year mark, and we are approaching the 1.5 million mark. Now it is time to get into the ratios that we discussed earlier. That is, 150,000 rupees gets into PPF. We could have 600,000 getting into the sovereign gold bond, allocating 750,000, and the remaining 750 now gets allocated into the equity market, and giving you now a much more aggressive growth oriented base, because your savings have increased significantly. Now, the last case that we'll discuss here is if your savings exceed 15 lakh or 1.5 million per year, then in that case, you are officially welcome to use derivatives as a potential source of income. And these derivatives products now become responsible to fund the subsequent income sources. So, PPF and sovereign gold bond is something that you have to take care of yourself, but the derivatives definitely should be responsible for creating your equity base. And in that manner, you would have as a stepping stone, as an HNI, you begin to include all financial instruments into your basket. And that about in my view concludes a simple approach. I would just like to end with a note saying that I have ruled out corporate bonds, because I just think that why do them? They don't add any value at all, and odds of a company failing are quite high. So I do not cover that. I will not be discussing that anytime soon. But yes, just a quick wrap up. We have PPF, sovereign gold bond, and equities to choose from. When your capital base is low, you go for safety at your topmost priority. As your capital base increases, you start taking a little bit more risk, and once you reach a slightly higher capital base, you bring in complete growth orientation. And upon crossing a threshold, you bring in income sources into your portfolio, which should hopefully fund for your assets, and here your assets being equities. If you like this video, do share, like, comment, etc. And if you have any further queries, I will be more than happy to help you. You are free to contact us at this number, and we can help you with your equity investments and derivative trading. So I hope you have a good weekend, and thank you for your time.